Big changes are on the horizon for your taxes. The clock is ticking, and many of the tax breaks we've come to rely on are set to expire in 2025. What does that mean for your income, your deductions, and financial planning? Stick around because understanding these changes now could save you thousands in the future. Hey taxpayers, it's Tiffany Gonzalez CPA here, and unfortunately you've heard it right. You're probably going to pay more taxes due to some tax policies set to expire in 2025, but there might be some hope on the horizon. Let me tell you more. The Tax Cuts and Jobs Act, or TCJA, was signed into law in December 2017 by President Trump. It's often referred to as one of the largest tax reforms in recent history, but many of its provisions are temporary and set to expire at the end of 2025 unless Congress takes action. So today, I'll break down the key areas that could see changes and what you can do to prepare. First, let's talk about the individual income tax rates. Under the TCJA, most tax brackets saw a decrease. The top rate dropped from 39.6% to 37%, and rates were adjusted for all the other brackets as well. These reductions brought a temporary boost in take-home pay for many households. However, if the rates go back up in 2025, those in the higher tax brackets could see a significant increase in their tax bill. The 37% rate would return to 39.6%, and lower tax brackets would also see increases. For example, the 12% bracket would return to the 15% bracket, and the 22% bracket would go back up to the 25% bracket. If you're in a high income bracket, you might want to consider tax saving strategies now, like maximizing your retirement contribution, using tax deferred accounts. So I truly recommend you reach out to your CPA to prepare as soon as possible. Another major change that the TCJA introduced was the doubling down of the standard deduction. This deduction went from $6,350 for a single filer in 2017 to $12,000, and it's currently at $14,600 in 2024. This change meant fewer people itemized their deductions, as the standard deduction became more beneficial for many taxpayers. With the TCJA's expiration, we could see the standard deduction shrink back down to pre-2018 levels, which means more taxpayers might need to return to itemizing in order to maximize their deduction. This could mean higher taxable income for millions of households. Now would be a good time to review potential deductions you may be able to itemize, like charitable contributions, mortgage interest, medical expenses, and consider if itemizing could be beneficial down the road should things change. For families, this next one is a big deal: the child tax credit. The TCJA doubled the child tax credit from $1,000 to $2,000 per child, and it made $1,400 of it refundable. This change helped so many families across the income spectrums. But if the TCJA sunsets, the child tax credit could drop back down to $1,000 per child, with potentially fewer families qualifying for the credit. Also, the additional credit for dependents like elderly parents or other relatives could disappear. So for families who benefit from these credits, you really need to start planning for a potential drop in tax credits unless things change. If you're counting on these credits, keep an eye on legislative updates. It's also a good idea to look into other tax credits or benefits that you might be eligible for to help make up any difference. Now let's talk about the state and local tax deduction cap, or SALT. The TCJA capped the SALT deduction at $10,000, which was a tough pill to swallow for taxpayers in high tax income states. Without any changes, this cap will expire in 2025, potentially opening up larger deductions for those paying high state and local taxes. For those who expect to itemize in 2026 or beyond, this change could mean substantial savings for you. You may want to review your state and local tax payments and consider how the return of full SALT deductions could impact your taxes. The mortgage interest deduction saw a reduction under the TCJA, capping it at mortgage debts up to $750,000 instead of the previous limit of $1 million. This change, along with the SALT cap, impacted homeowners who could afford more expensive homes. If these provisions sunset, the mortgage interest deduction may increase again. So homeowners with large mortgages or those planning to buy one may want to monitor this closely, as the ability to deduct higher mortgage interest could potentially provide you tax relief in the future. Lastly, let's cover the estate tax exemption. The TCJA roughly doubled the estate tax exemption from $5.49 million per individual to over $11 million. But after 2025, this exemption will likely return to pre-TCJA levels, which means estates over approximately $6 million will be subject to the estate tax. If you're in a high net worth bracket or family, this is a key area to prepare for, as estate planning may be essential to protect your assets from a potentially higher estate tax. Working with a CPA specialized in trusts or other estate planning tools could help you minimize tax exposure in that area. So there you have it. Those are some of the major tax changes set to expire in 2025 unless President Trump and Congress takes action. What do you think? Are you ready for these changes? If you found this video helpful and insightful, don't forget to hit the like button, subscribe to our YouTube channel, and follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.